Financial crises feel sudden, but institutional responses are not. They follow a pattern. A shock appears. Markets fall. Credit tightens. Confidence weakens. People look for stability. In those moments, speed matters more than ideology. Decisions are made under pressure, not in theory, but in real time. History shows something consistent. After crises, institutions grow. Rarely shrink. This is not a theory, it is an observable pattern. After 1907, the Federal Reserve System emerged. After the Great Depression, deposit insurance appeared. After 2008, oversight bodies multiplied. Each reform had a justification. Prevent recurrence, restore trust, stabilize markets. These goals were not irrational. They reflected the fear of recent memory. What changes during a crisis is not just policy. It is tolerance for intervention. Measures once debated become acceptable. Measures once resisted become necessary. This matters because institutions grow most easily when alternatives feel risky. Crises compress time, deliberation shrinks, urgency expands, and urgency favors action over restraint. The outcome is rarely planned expansion. It is reactive expansion, not designed in calm, built in response. The question is not why this happens. The question is why it happens so reliably. To understand that, we look at incentives. During stability, limits feel reasonable. During crises, limits feel dangerous. A policymaker who acts too slowly is blamed immediately. A policymaker who expands authority is judged later. If at all, this creates asymmetry. The cost of inaction is visible. The cost of expansion is delayed. Delayed costs rarely shape urgent decisions. Immediate risks do. This is not corruption. It is human behavior under pressure. Voters want reassurance. Markets want liquidity. Depositors want access. Institutions provide visible solutions. Even if the long-term effects remain uncertain, this is interpretation, not accusation. History suggests people accept concentration of power when stability feels threatened. Safety becomes the priority. Structure becomes secondary. Once new powers exist, they develop constituencies, employees, advisors, dependent sectors. Removal becomes difficult, not because it is impossible, but because it is disruptive. Institutions, like markets, seek continuity. A crisis may justify creation, but continuity sustains existence. Expansion, then, is not only about fear. It is about momentum, and momentum is hard to reverse. Emergency measures are introduced as temporary. This is often sincere, but temporary tools solve real problems. That success builds trust. Trust builds reliance. Reliance builds permanence. Consider historical examples. Wartime capital controls, crisis lending facilities, guarantee programs. Many outlived their original purpose. Not because of deception, but because removing safeguards feels risky. This is a structural dilemma. If a tool prevents collapse, who argues for its removal? The absence of crisis does not always feel like proof. It feels like uncertainty. So institutions remain, refined, expanded, renamed. Over time, what was extraordinary becomes normal. Future generations inherit the structure without inheriting the fear that created it. This creates distance, and distance softens scrutiny. None of this requires conspiracy, only incentives, memory, and caution. The result is gradual accumulation. Layer upon layer, rarely removed, mostly added. Institutional expansion does bring stability. That is the reason it occurs. Many crises were softened by larger backstops. Many collapses were prevented. This is fact, not opinion, but trade-offs exist. Centralization reduces fragmentation. It also reduces dispersion of power. Larger institutions see more of the system. They also influence more of it. Whether this is good or bad depends on perspective. History does not give verdicts, only outcomes. What we can observe is the pattern: crisis, response, expansion, then memory fades. Until the next shock, the cycle does not require design. It requires conditions, and conditions return. Because financial systems are built on confidence, and confidence fluctuates. So institutions grow not only from ambition, but from repeated rescue. The outcome is not a plot. It is a trajectory, a quiet one, visible only in hindsight, and often recognized long after the moment that shaped it.